Divergences are one of the most powerful concepts in technical analysis, and one that I get asked about all of the time when I post a trading strategy video, so I know you want to learn more about it. That's what we're going to talk about in this video. But let's start by talking about what is a divergence, because not all of you may know. A divergence occurs when two or more things start to move apart from each other. In trading or investing, this occurs when the price of the instrument is moving in one direction and then the technical indicator is moving in the opposite. Now, the reason why divergences are so popular is because many traders believe that they serve as an early warning signal of potential market reversals or that a trend could be resuming. However, understanding how to identify and trade divergences effectively is very important, and they can significantly enhance your trading strategy by helping you pick better trades if you know how to do it right. And I'm going to share with you towards the end of this video one of my favorite ways to trade divergences. But in general, they are indicators and patterns that help you avoid joining a trend before it's exhausting and allow you to spot market turns before they become obvious. Don't you want to do that? I'm sure everyone does. In this guide, we'll explore the different types of divergences, how to spot them using a combination of popular indicators, and effective ways to trade them better. There are two types of divergences, regular divergences and hidden divergences. We'll take a look at these in further detail, but before doing so, if you like our videos, please make sure you subscribe to our channel so you don't miss more trading tips and strategies like this. Also, if you want to learn more about trading, we got some great free trading courses in our community. That's free too. There's a link in the description in this video for more details. So let's start with regular divergences. Regular divergence is very popular amongst traders who like to pick tops and bottoms, as it can be a very powerful reversal signal. It occurs when the price is making a new high in an uptrend or making a lower low in a downtrend. But we usually use them in combination with the technical indicator like RSI and stochastic, and you want to see that moving in the opposite direction. With regular divergences, there are two types, the bullish divergence and the bearish divergence. This is what a bullish divergence looks like. In this 4-hour dollar-yen chart, you can see price hitting a new low. But right down below is the relative strength index, or the RSI. And instead of falling further, it actually makes a higher low, which suggests that selling pressure is weakening, and there could be a reversal to the upside. Now, once again, if you watch the end of this video, I'm going to share with you a very cool way and powerful way to combine divergences with moving averages, which is my favorite technical indicator to find high accuracy trades. Meanwhile, the opposite of a bullish divergence is a bearish divergence, where price forms a higher high, but the indicator forms a lower high. And you can see a classic example of that in this 4-hour euro-dollar chart. Take a very close look, and you can see that the price is forming a new high. But if you look at the bottom of the chart where the relative strength index is, the RSI is actually falling, which indicates that buying momentum is fading and hinting to you that a potential reversal to the downside could occur. Hidden divergences, on the other hand, are trend continuation signals. They're not talked about as often, but they can also provide some powerful signals, and you want to learn how to identify them. Hidden divergences occur when the price makes a higher low in an uptrend or a lower high in a downtrend, but the indicator is doing the opposite. Since this is a trend continuation pattern, it's the most effective on shorter time frames like the 15-minute gold chart. Gold has been an uptrend. At the Sunday market open, like you see here, gold rallied and then stalled. The stochastics made a new low, but there was no real movement in gold. No new lows set alongside it. This could be a sign that a pullback is losing momentum and the uptrend is likely to resume. We see gold actually gradually ticking higher with more higher lows and stochastics also moving back up. But by the London session, gold actually breaks out of its tight range and confirms the bullish hidden divergence. Now, in this dollar CAD chart, we have something different, which is what we call the bearish hidden divergence. You can see that a new high in stochastics is formed, but that same candle, we actually see the price make a higher low. It takes some time for dollar CAD to actually move, and that's okay. But the subsequently lower high in the stochastics confirms that the upward momentum is fading and that the downtrend is likely to continue. The most popular indicators to pair with price action to spot divergences are the relative strength index and stochastics, which measures overbought and oversold levels. The MACD, which is the moving average convergence divergence, is also very popular, and it's a trend following indicator that shows a relationship between two moving averages. Combining the indicators with price action can give you important clues that aren't necessarily visible by looking at the price action alone. While divergences and price action can provide some powerful signals, more for regular divergences than hidden divergences, they are the most effective when combined with candlestick patterns or other indicators. Common ways to trade divergences include entry strategies where you enter on a confirmation of a divergence, such as a break of a trend line or a strong reversal candle like a hammer or an engulfing pattern or a Marubozu, which I love if you watched my candlestick video. For bullish divergence, you could also wait for price to rise above our support level before entering long with a stop just below the swing low of the divergence. For bearish divergence, it may be wise to look for a break of a key support level before entering short with a stop just above the swing high of the divergence, using the next support and resistance levels as the take profit zones. My favorite way to trade divergences is to combine the RSI with moving averages. So let's go ahead and take a look at the charts. I think it's more effective on 1-hour charts. It also works on 4-hour charts. I'm going to go ahead and add the RSI. So we can type in indicators, click in RSI. And in this strategy, we have the RSI, which we're going to be looking for divergence on, and we're going to combine it with moving averages. So the moving averages that I'm going to add on, we're just going to add on the simple moving average. Simple moving average, we want the classic one over here, okay? And we want to add 2 of them. We want to add the simple moving average, and we're going to change this to the 5 SMA, and we can leave it blue. And this other moving average here, we're going to change this to the 50 SMA, and let's make it a different color. What should we choose? All right, let's see. Let's make it red. All right, that's easy to look at. So now you have 2 moving averages. So we want to look for divergence, but what we also want to do is we want to make sure that we have confirmation in our moving averages and only take the trades with the moving averages as the guide. So let's see if we can find a divergence here. All right. So here we see, here's a good example. Here we see price make a new low. Let me point to this arrow over here. We see here, price make a new low. But the divergence here is, if you look at the very bottom, the divergence here, you should be looking at these numbers over here, okay? The divergence, and look at the purple line. The divergence here is 26.78. That's a purple number. The divergence here is 27.05. So price is making a new low, but we do not see the indicator. We do not see RSI making a new low. So that is what we call a divergence. So you could just buy right here, which, could be an effective way to do this, or you can wait. And what I would do is, the best way to wait is I would wait for Eurodollar to close back above the 5 SMA. So this would be the point where I would go long. And, this is a 1-hour chart, so I would say probably about a 20-point stop, and then, 20 to 40 points as your target. So you can see here, this one you would go long at 112.30. So this one actually doesn't work out. It gets stopped out. But that's okay, because not all trades are winners. And this one, it actually becomes a very nice mover. And we also have a divergence here. So in this divergence, we see price making a new low here. And again, down here, RSI is not making a new low. RSI is rising. This is a stronger move because, first of all, not only is it the second time that we're seeing this divergence, but we're seeing a much more significant change than we saw over here. But still, the rules apply. We wait for a close over here at 112.22. It closes at above the 5 SMA, showing you that a turn is happening. So using the 5 SMA for confirmation. And this case, it doesn't even go anywhere near the stop. You enter at 112, let's say 23. So if you had a 40, a 2-for-1 target, it'd be 112.63. But what I would say is you would close first half of your position when it touches the 50 SMA. That's why we have this 50 SMA there. And then you can trail your stop. And you can trail your stop. I'll show you how to do it in a little bit. But let's see if we can find another divergence in Eurodollar. Do we have a divergence here? Here, we kind of have a divergence. Here, we basically have price making a new low. So Eurodollar makes a new low here. And once again, we do not have RSI making a new low. This low is higher than this low. Instead of just buying arbitrarily, which you could, but want a confirmation. So you can go long here. So you go long here, 113.10. And so you want 20 to 40 first target, depending upon your risk tolerance, and a 20-point stop. First target is hit over here, and then you can target the next position over here, and then trail your stop if you would like. But it shows you a much more effective way to see if you can find that divergence. Let's see if we have another divergence here. Now, this is very interesting. This is kind of like a divergence, not really, because price is the same, but depending upon which broker you have, it could be making a new high. But you can see here that, it's retesting the high here. And, the RSI here does not make a new high. We actually start to move lower in the RSI over here. And what you would do is you would wait for it to close below the 5 SMA, which gives you confirmation. So you can either target 20 or 40, depending upon what type of, how long you want to squeeze the trade. 40 is a pretty big move. 20 for a day trader is more likely for the first half of the position. And then you can target the 50 SMA on the other side if you would like. Let's take a look at another example in dollar yen. Let's see if we can find a divergence plus moving average RSI combo in dollar yen. Let's see. So here we have price 146.19 making a new high here. Ooh, this is a beautiful divergence. Price making a new high. This high is higher than this high. Look down here. RSI at this point is over here, which is definitely lower than here. So once again, we have a divergence. And this one is actually really nice because this one, we actually had to close below the 5 SMA right at the candle at 145.70. And we haven't, you can go to 20, 40 pips and targeting the 50 SMA. We haven't quite gotten there yet, but it's still by about 90 points in our favor, which is a beautiful, nice divergence move here. Let's see if we have a divergence here. No divergences here, but that was a very, very nice divergence move. Here is another great example. Here, price makes a new high. And actually, we're looking at this in 1-hour chart, so it works really well in 1-hour charts and 4-hour charts. I'll flip back to the 4-hour charts in a minute. But the 1-hour charts, you see price making a new high, RSI not making a new high, but we just don't sell arbitrarily. We wait for it to close below the 5 SMA and then beautiful move lower, targeting the 50. We go to the 4-hour chart. Let's see. 4-hour chart in dollar yen. Price making a new high here. Same story. New high here in dollar yen price, and we get a divergence, no new high in dollar yen, and once again, beautiful move high, lower here. And the euro dollar, if we're looking at the 4-hour chart, which I didn't realize, honestly, I apologize, that we're looking at the 1-hour chart, let's see if we get any divergences here. Here, we have a new high here, beautiful. So new high in euro dollar over here, we get a divergence. We do not make a new high in euro dollar. We wait for it to close below here, and then you're targeting the 50 SMA, and this one, 115.10, it does retrace a little against you, but it looks like it's better on the 1-hour chart, honestly. Either way, this is the way you combine moving averages with the divergence. Works really nicely in the 1-hour chart, not so bad in the 4-hour chart either. I hope you enjoyed my favorite way to trade divergences, but feel free to make divergence trading your own. The key takeaway is that when you see a divergence with 2 different indicators that tell 2 different stories, it could be a red flag of something that is happening and changing. By learning to spot momentum shifts before price reacts, you gain an edge in anticipating market moves. You can apply these principles with proper risk management, and you will see the value of divergence trading unfold in your trades. Now remember, in trading, risk management, it really is everything. You can have the most effective strategy, but without proper risk control, success is impossible. That means always setting a stop loss. Divergences signal potential shifts, not a guaranteed reversal. So protecting your capital is critical. Also confirm divergences are higher time frames for stronger signals and wait for the price action to validate the setup before entering. Finally, avoid over-leveraging. Risk only a small percentage of your capital per trade to ensure that you can trade another day and that you have long-term survival in the market so that one trade doesn't work out. If you have a unique approach to spotting divergences, I want to hear about it. Share your thoughts in the comments below. Let me know how you use divergences, what indicators you use in combination. And if you're serious about leveling up your trading skill, join our free trading community where you can access free trading courses and connect with other active traders. Click on the link in the description and join us. Let's trade smarter together, and I'll see all of you in the next video.